Hello and welcome to Chapter 16. Chapter 16, we're going to focus in on job order costing and how job order costing works within a business. Our learning objectives for Chapter 16, we're going to distinguish between job order costing and process costing and talk about the different types of firms and which one uses each method. We're going to calculate a predetermined overhead rate to assign overhead to units or services produced. We're going to identify and set up source documents for a job order cost system. And we're looking at the cost flows for a job order costing system. Let's start first with discussions about the difference between a job order cost system and a process cost system. And typically, a job order cost system, they're going to produce what you would call heterogeneous products. An example I like to look at is if two people got in a car wreck. No two car wrecks and no two repair on a car wreck are exactly the same, irrespective of the exact same car. There's going to be differences between the two, and they want to track each individual cost for each individual car wreck based off of the car, based off of the cost, based off of the repair that needs to be done. That's essentially a job order cost system. Process costs are typified by heterogeneous products, which are essentially always the same. Think of Campbell's soup coming off the production line, or you might also think of a car company that makes cars. Because generally speaking, a Ford Focus, the trim line might be different, but other than that, a Ford Focus is going to look exactly the same, irrespective of, of the production. And you can see that, pardon me, Uh, so car manufacturers can generally produce a homogeneous product, which means the same. And we're going to look at, there'll be some more characteristics that we'll look at. In a job order cost environment, each one is distinct. So think about our example with a car wreck. So they're going to keep track of the cost for each individual car because you don't want to pay for somebody else's repair. And it's a built to order. I mean, you might also think of wedding dresses. That's going to be a job order type environment because no two young lady when they're ordering their wedding dress is going to be the same. Some are going to be taller, some are going to be shorter, some are going to be heavier, some are going to be lighter, etc. Not in addition to the color and the lace and all the other stuff. So each one of them is going to be different, and they accumulate the cost by job because they want to figure out if they're making money. Whereas a process cost system, they have examples here: food canning, cement, petroleum and pharmaceutical manufacturing. I could also think of cars as another prime example. We talked already about Campbell's soup coming off the line. You can't differentiate one from the other. And what we're going to do is we're going to take total process cost divided by the units, which may be cases of Campbell's soup, and that's going to tell us how much it costs us to make a case of Campbell's soup. That's in a process cost system. Here's just a summary of the differences between the differences in the same things. So you here notice homogeneous products. Here it would be where it says a variety, I would say heterogeneous products. And it's accumulated by a job. This one's accumulated by a department. And you're taking the total job cost and you're saying, what did this job cost me? So there's really the output typically on one of these in a job order cost, more often than not, is going to be one. It's not going to be multiples. But it could be depending upon what you're doing. Maybe you're doing a job order that has t-shirts that you're making specific t-shirts. My brother runs a business that does that. And that's not heterogeneous exactly because maybe you have different names. It's not homogeneous because they have different names on the back of the shirts, for example, and different sizes. So it's a little bit different. Um, so you have normal costing and overhead application. The reason we want to talk about normal costing and overhead application is because costing is important to determine whether or not a business makes money and how they determine their pricing decisions. And they want to understand what they're doing in their business. So we also have something called actual costing, which takes the actual cost and assigns it to each individual product. And there's some issues with that. One of those is that defining what overhead costs are. A second one is overhead costs are expended unevenly through the year. For example, if you live in Texas, the higher part of your cost for utilities are going to be in the summer for air conditioning. You don't have quite as many costs for heating in the winter as you do air conditioning in the summer. And the production doesn't happen evenly either. I want to surmise that production through December is probably going to be light relative to the manufacturing, depending upon what kind of product you run. So in a normal cost system, uh, you're solving problems associated with the average costing system, and you take the actual cost for direct materials and direct labor and an estimated overhead. And virtually all companies use this normal costing system. It's an importance. It helps. What's the importance of unit cost for manufacturing firms? It allows them to. It's a huge piece for them. It helps them to value inventory, determine income, and make other decisions for their business. They use it for costing inventory based off of GAAP. They use it for cost of goods sold. They must also know the number of units and cost on hand. It's a full cost. It has overhead and labor and everything else included in it. Overhead, direct materials, and direct labor, and it's viable. They need to cover the cost. So this last one, price needs to be greater than cost. Service companies have the same thing, but think of a service company like a bank. A bank wants to figure out how much it costs their tellers, how much it costs them to serve you with their tellers, and they're going to figure that cost out so they have an idea of how many tellers they need, etc. It's a little bit different, but the same type of deal. Or a rent a car company would also be a service company. How much does it cost them to per rental day per car? That's because they have a service company and they have to figure out what that means to them. There's ethical decisions with that and how not what the cost is, because what happens is all these different examples is what does it really cost to make something in a nonprofit. Governmental agencies need to track costs, and a cost accounting system typically in what's something called an ERP, and you might see this with enterprise resource planning, is one thing. And another thing that's really interesting with all these costing systems is that you might do a cost plus when you sell something to the government. So it's critical that you keep track of your costs appropriately. So what we need to do in a normal costing system is we have to estimate overhead. And the way we do that, we calculate a predetermined overhead rate. That's the first step. Then we're going to look at applying that overhead to production throughout the year. And then we're going to look at the difference between the two. So what we do, and this is a lot of what this is really saying. If you read through all this, what this is really saying is, what was my budgeted annual overhead? What was my budgeted annual activity? And you calculate what the difference is on some type of a predetermined overhead rate. Most of what you're going to see in your text and in the materials you see is it's going to be a percentage of direct labor hours or a percentage of direct labor dollars. And that's what we're going to see here in this particular chapter. You can also see that some organizations will use the unit of activity might be pounds produced, for example. So you might allocate overhead on a pure pound basis, irrespective. That's just another way of doing this. And this is a traditional costing model. We're going to look a little bit at something similar to what's called activity-based costing, but it's not in the detail you would see in the real world, where you establish activity rates based by department. A little bit different, closer to activity-based costing. What we're going to do is we're going to take the predetermined overhead rate times the actual activity. So in this case, what we're going to do is we're going to take total costs. They're going to be actual direct labor, direct materials, plus direct labor, plus applied overhead. And this is going to give us a normalized cost or normal costing uh, for this model. So what we have here is we have overhead for the year was 360, direct labor cost was 720, and we're going to calculate a predetermined overhead rate. That's what we're doing first. We're doing our step one, and it says that we're going to use 50% of direct labor costs is what we're going to assign. So it's 0.5. And you notice we had $56,000 in direct labor costs. You multiply that times 0.5. And it says we're going to allocate $28,000 of overhead to a particular job and job order costs. So we have actual overhead are the costs that we've tracked through the year. So that's the dollars that we've truly spent. Applied overhead is what we've applied to given jobs throughout the year. And we're going to look at the difference between those two because they're hardly ever equal. Generally, they're not going to be exact. So if actual overhead is 400 and you only applied 390, you're under applied by 10,000. If actual overhead is 400,000, you applied 410, you're over applied. In other words, you've assigned more overhead to the jobs than what you truly spent in a dollar basis. And that's what the difference is. So if we look here, we have to figure out what to do with that overhead. Generally, it goes to the overhead variant. The overhead goes to cost of goods sold, and it's going to under applied is added to cost of goods sold, and over applied is subtracted. So it saves you money, it reduces your cost. That means that you ran more than what you were supposed to. There's a little bit of a distinction as well with spending, but we're not going to cover that here. And here's a picture graph of that same thing. And you can kind of look through this, but it's missing something with the cost of goods sold because um, this kind of gives you a perspective. You might want to pause this and think about this, but this is really what it's saying. Over applied says that you applied more than what you spent, and it's going to go to cost of goods sold, and it actually is a reduction in cost of goods sold. So these pictures don't quite paint the right picture because I think this should be taller and this should be short. This should be shorter over here. But you get the concept. It's really a reduction in cost of goods sold. So here's our over or under applied variance in this case. So we're going to take this other $400, which seems pretty low. And what's under applied, you notice that our cost of goods sold was higher, so 632.4. Now, if it was the reverse and we were over applied here, and this was a minus 400, that means that it would be 631,600 because you're going to have a reduction in cost. Now, if we have departmental overhead rates, before we looked at were plant-wide overhead rate or traditional or overhead rate. That's what's that's essentially what activity-based costing, I mean traditional costing did. And this departmental one would be much closer to activity-based costing. Not quite, but it gets it closer so you can get a little bit more accurate cost based off of this departmental overhead rate. And here's how you're going to calculate it. You can look at these, and I'm not going to go through all the calculations, but you can kind of see what happens here. They want to apply overhead based off of these different dollars and it's based off of these machine hours. So you're going to look at machine hours here, and you're going to look at something a little bit different with each one of these. And this kind of gives you an idea of what happens. And let's look at the calculations for machining. It's 240 divided by 200,000, so it's $1.20 per machine hour. And for the assembly department, it's by direct labor hours. So why would they do these differently? Because the cost drivers in those departments are different. So they're going to apply cost differently, and you can see the calculations down here. And you can also see the over or under applied. And in both cases, you are under applied. So that means that your activity measure was less than what you had anticipated. And when you now when you so you can kind of see what happened here over or under applied as well. So we're doing a little bit more of that. I want to calculate a unit cost in a job order system. So you might be producing a batch of something in a job order system. It might be a specific thing like we talked about t-shirts in my brother's business, and you're going to calculate what it truly costs. And why do you want to do that? Because you want to determine what you're going to sell, say, a soccer team, a group of shirts for, as opposed to just giving them a blanket number. So here's the calculation for that. You have, in this case, it's backpacks. And this is what they produce. This is how much they assign direct materials, direct labor, and an applied overhead. So they have $2,320 and they had $20. So each backpack cost them $116. And you think, wow, that's high. Well, if any of you guys, if any of you people on the phone or listening to this or listening to this discussion have a son or a daughter that's in high school athletics or dance or cheer, 116 is probably pretty right because the school logo, they'll have their name, and they'll be the fanciest backpacks you ever saw. So you understand. And I'm speaking like a true accountant. The job order cost sheet is a subsidiary of work in process. So what's happening is it's actually a subsidiary ledger for the work in process account. Think of it like at the school, you have a subsidiary ledger as well for accounts receivable, where each one of you guys has a bill, owes the school some money. Well, that rolls up to accounts receivable, maybe for the fall semester. Well, that's exactly what these job order cost sheets are, and it's a subsidiary for work in process. And what you have is you have different forms that you use for work in process. The first one is a materials requisition form. It keeps track of what they issued for a particular job. And this one's to the assembly department to make briefcases, and they ordered buckles, and they got 10 of them at a cost of $3 and a total cost of $30. And this is the requisition form, and they use this. And typically, in an organization, they might automatically do this within a computerized system, but in a smaller business, you might see this tracked manually. Um, but you notice here where it says no attempt is made to trace the cost of other materials These are consumables, supplies, lubricants, and like to a particular job. These are considered indirect materials, and they'll go through the overhead department. This next one has to do with labor and how we assign labor to the job. And it gives you the total time. And it's probably not just one person. It might be multiple people, but we can't see this here because you probably are not just going to have one person on a time ticket. You may have several. So you got to be careful there with that, but that's a calculation you make as well. So that's direct labor, and you can see the pieces, and that's going to happen typically in an ERP system. And you might use something called Chronos, like when you swipe your badge. You might have something on the line that you work at. You're swiping your badge, and you might have to put in the job number when you start, and you swipe it when you're done. That's going to be typically what you're going to see for jobs, and that's all going to go into work in process for unfinished jobs. So you have materials, work in process, you have applied overhead. These are the subsidiaries for each one. So this is a standalone account. This is a standalone account, and this is the job sheets that roll up into the work in process. And then when you sell them, you're going to take them out of finished goods and go to cost of goods sold. And that's going to be all part of the income statement over here on the right. So here's a way of doing this in Excel, and you can see that this is calculating the materials and what they had and what they issued. So you had 1,500. It looks like they have 1,000 that were issued to direct materials for this particular job, and then you had another 500. So you have 1,500 total for materials, and you have two different jobs. One's backpacks and one's briefcases. So these are two different job sheets. This is just the first part of the work in process account. You add to it the direct labor, or again, backpacks and briefcases. And here's the calculation for that. And then you have overhead and you apply it to each job. I know I jumped over this slide, but I think you can follow that. If you want to go back and pause, you can, but you apply overhead to each job. And it tells you the number of units, and then you're going to calculate the total cost for each. And it's going to tell you what they cost for each one. And here's the unit cost for the backpacks. And it looks like the briefcases aren't quite done because we don't have a unit cost here yet. So they have a little bit more to go with the briefcases, but they've already finished the backpack. So when we finish the backpacks, we're going to move them out of work in process. That's what this shows us, and we're going to put them into the finished goods account. And then when you sell them, they're going to go out. And here's the job sheets and what they look like. And this is just a little bit different. And I'm not going to go through all this stuff with you, but you can follow the calculations for each. The predetermined overhead rate, you already had all the other stuff that it gave you. And you're going to apply it. And then what's going to happen is you're going to transfer some that went to finished goods. These two went to this job 70. So you have these that are sitting in finished goods. And if you go back, you had still one other job that's not done. It's still in work in process, job 81. These other three went to finished goods, and it looks like you sold job 79. So you reduce that, and you credit finished goods and you debit cost of goods sold, and then you credit sales and you debit accounts receivable if it was on account. Okay. So here's the income statement. This is just that one sale of that item. You have gross margin, and then you have operating income, and these are fixed costs. So these are period costs here. This is product cost, and this is the net operating income. That's the end of chapter 16. I know it was a short chapter and sweet. I look forward to discussing chapter 17 with you here shortly. I hope you're having a great